Welcome to YES Securities, where we don't just secure investments, we secure your future. In the ever changing landscape of finance, one thing remains constant: the need for a reliable partner. At YES Securities, we are not just wealth managers, we are architects of financial success. Our experience over the last decade has been a steady and remarkable journey leading to growth in the labyrinth of financial opportunities. We don't just find a way, we create it. We don't build walls, we build bridges that connect ambitions to achievements. Innovation is not just a word for us, it's the heartbeat of every decision we make. Your success isn't just a goal, it's our mission, our commitment to your financial journey. We provide world class solutions across multiple products, catering to institutions, high net individuals, and retail investors across sectors. Because your success is our business. Yes, Securities, empowering tomorrow.
Hello, everyone. Welcome to our new session of YES FinPulse, a webinar series dedicated to exploring the technical aspects and broader discussions in finance. As we all know, our mission at YES Securities is to make finance accessible to everyone, regardless of background or experience. Over the past decade, we've evolved from a transactional broker to a trusted advisor for both retail and institutional clients. Now, let's get down to business. Our topic for today: assess, align, and achieve navigating fixed income securities. It is my pleasure to introduce our esteemed speaker for today, Mr. Sachin Shardul. Sachin manages the multi asset desk at YES Securities Limited with a keen focus on fixed income investments. With approximately 12 years of extensive experience in product and investment management, he has been a valuable asset to various companies throughout his career. Today, Sachin will share his deep insights and knowledge on the basics of fixed income, a critical area of finance. And guess what? If you miss any of our sessions or want to revisit the valuable insights shared, don't worry. We'll be uploading the entire series to YouTube under a playlist named Yes FinPulse, so you can catch up at your convenience. Remember, this isn't just a one way street. We want to hear from you. After Sachin's presentation, don't hesitate to ask questions and share your doubts in the comment section. Your engagement is what makes this series truly special. We have polls and quizzes coming throughout the webinar, so be alert. Over to you, Sachin.
So hi guys, welcome back. It's pleasure, sort of talking to you guys again and again. This is our third session. Just for the benefit of everyone, what I'll do is sort of brief you on what we've already discussed and what we're trying to achieve here. So the aim again here is to sort of make everyone aware of fixed income as an asset class, get into the nitty-gritties of what sort of makes this asset class, what should one be keeping a lookout on, how to sort of read or understand the prices in the market that fluctuates. We had started from the basically uh, going through components of fixed income, wherein we discussed the coupon, face value, maturity, what sort of ratings, and yield and prices that sort of decide the fixed income securities. Then moving on to the second session, what I wanted to sort of do is give you a basic of how to assess, align, and achieve your investment goals via fixed income. In the first part, we covered how to assess fixed income securities, under which we covered multiple risks that sort of are there or one should look out when investing in fixed income. So basic few risks again, just to brush up, is credit risk, interest rate risk, liquidity risk, and market or demand supply risks. Right, that is what we covered in our last segment. Um, and now what I want to concentrate on, how to basically, how can one align or take advantage of fixed income as an investment class and make most out of it. So while I was sort of thinking of getting into the details of how one should read the quotes, what sort of options are available, and all sort of things, what sort of picked my brain was, it would make more relevant for everyone to sort of, align their goals until unless one really knows what their financial goals are, right? That the basic of any investing, right? One should always and always have financial goals. And then sort of, depending on what sort of goals you have, what sort of risk profiling a particular, investor has, and then move on to, sort of assessing or looking into multiple asset class, and then finally choosing an asset class which suits best to take care of your financial goals and sort of manages your risk profile. Um, so I thought it's very important to first speak about financial goals, and then sort of understand the advantages of fixed income, so you will be able to align your goals to this particular asset class, and then moving on to the types that are available, and how should one read the quotes or the price components of fixed income securities. So that will be the goal today. So then, yeah, moving on to our first topic, types of goals. Very basic, but as I said, I just thought I should spend some time on it. Uh, Comparatively, the multiple, there could be multiple different types of goals, but one overall bucket, if you had to prepare, it will only be short-term, medium-term, long-term goals. And as I've given few examples, short-term goals could be anywhere between a travel plan or a discretionary spend or some sort of bill payments, right? That could be a short term which you want to accomplish within a year. What basically this means is, uh, the need for money will be very early, and you need to be cognizant of where you're investing your money. Then moving on to midterm goals. Midterm goals will be anywhere between which you would want to achieve in 1 to 5 years. Could be any large purchase as a car, or consumer goods, etc. Multiple types of fees, tuition fees, coaching fees, whatever you would have for your children, or your own sort of education, so to say. A small asset creation if required, that could be considered as medium term goal. And again, long term goal, anything which will take beyond 5 years. One would be obviously retirement if you're planning to buy a house, and again, education, higher education fees, not just regular fees. So if you're wanting your children to sort of go abroad and all those things, you would want to start planning for all of them, now. So I think ideally everyone should have financial goals before you start, even before you start your investment journey, and sort of bucket them in these three categories. Now, after one more thing that's a problem, or I've sort of heard from a lot of people whenever I've talked, a lot of clients, colleagues, friends. Uh, Anyone who asks me for a financial advice, my first question always is what sort of goals you want to achieve, or what sort of financial goals you have. And generally the reply that you sort of get is, that there is no particular goal as such, apart from basic spends, travel, etc. Is only to sort of make money, or make your wealth grow, or have a wealth creation journey. So having said that, what I thought is, for everyone, after this, I think one thing, we should all go to our drawing board and ask us few questions, right? Obviously, if you can't bucket yourself, your goals in these three categories, must have sort of financial goals are, that you should always start working and start taking care of immediately. I'm saying, as like, you should start thinking about it as we speak immediately. Must haves is emergency fund, right? You should always and always have a emergency fund. You never know what sort of googly life throws you at, and what could come up in your life. We all together as a world went through COVID at a time when we thought everything was sort of ending. But obviously things changed, turned around, and everything. But COVID took a lot out of a lot of people, and people who were a better plan and had emergency fund came out scratch free. So I think first goal everyone should have is have an emergency fund. Basic rule is, you should have emergency fund as equal to your 6 month salary. Whatever your 6 month or half yearly salary, it should be your emergency fund kitty. Second, obviously, you should always constantly start working on being debt free. Whatever sort of debt, credit card, or whatever debt you sort of have in your life, you should always work towards being debt free. It's more of a mental piece, right? I think that's a must have. You should. I'm not saying you should always be debt free. Having some sort of debt obviously is good. There are a lot of benefits of taking credit or using credit cards or different sort of credits. It just gives you that convenience. But the aim should always be reducing your debt, or going debt free as much as possible. Then obviously having a good insurance policy, which will take cover of your dependents if, god forbid, in event happens. And obviously have a medical insurance, because medical bills today in India, if you don't have insurance policy, even in India, across the world, if you don't have insurance policy, just burns a huge hole in your pocket. So having a quality insurance policy, taking care of your basically a term plan and a medical insurance is of utmost priority after first two. Then obviously retirement planning, right? You should always and always have retirement planning. Doesn't matter what age you are, what sort of career path you have, or where you are in your career. You should always and always start your retirement planning as early as possible. That has to be in place. And then obviously, I just thought, why not? The whole point of working, or putting in effort day in day out, is you want an upgraded life. So I think that in the background should always be there, like tomorrow being better than today. So yeah, you should try and bucket your goals in short, medium, long. If you can't, you should always and always concentrate on must haves. Start working on those. And this is not it, right? Once you create your goals, that is not the end of the story. You should also ask yourself questions in regard to basically risk profile yourself. How much of a risk you are sort of okay taking, at what tenure you want to accomplish whatever you want to accomplish. How okay are you, if market fluctuates more than usual. What sort of feeling do you get when that happens? How okay are you to lose some portion of your invested amount if need be, in return of higher returns and all. So all sort of questions to understand the risk profile you have. So at one end you have your financial goals ready, and other end you have your risk profiling ready. When you are these two ready, then you go and assess sort of asset classes that are available to you. So if you're a very very risky investor, wanting to have your financial goal achieved in a year, you obviously will move towards a riskier asset class, which will sort of give you that return, but at the same time comes with the risk. On the extreme end, if you're a person who wants to have a very long financial term goals and wouldn't want to lose your money, or it's a money that is for something a very important use wherein you could not afford to lose the capital, you then move on to asset classes which won't give you as high return, but will give you a compounding effect over the period of time. At the same time, will make sure your invested capital is never depleted. So once you have that in place, then you sort of choose the asset class, and you have to understand the benefits of each asset class, understand the risk attached to each asset class in comparison to the other asset classes, and then sort of start your asset allocation and financial journey. So having said that, then moving on to basically the fixed income asset class that we are here to talk about, right? I thought it is important to really understand what sort of benefits there are in investing for an investor in fixed income asset class. First and foremost, it provides stability, right? Stability, why? Because at the end of the day, fixed income is a security. At the end of the day, is a promise to because it's a loan that you've given. So loan is always a contract. It's an agreement to pay an interest rate and pay the principal at the end of the tenure. Uh, so whatever happens in the market, it is not related to the promise, right? So it's a promise. So provide stability if you stay invested through and through to the till the tenure, right? Uh, your returns won't fluctuate, so you won't have to worry about if there are events happening in the market. You just have to worry about the quality of the investment that you have, if the quality is sort of deteriorating. Otherwise, there is no you can be stress free, because the even in the market side, the fluctuation is not as high as other asset classes. Then moving on to the periodic income. One of the best things about fixed income that I've been constantly sort of telling our clients and everyone that I meet is you get a constant periodic income which you can envisage. You can envisage the entire cash flow of your investment till the time of your maturity, because as I earlier said, it's a promise that they'll pay you x amount at a certain date for a certain amount of tenure, whatever the tenure that the contract is for or the security is for, and at the maturity you get your principal back. So it's a very simple sorted sort of a thing wherein you invest and you are sort of stress free. You know your cash flows, you can plan your cash flows, life goals around this particular investment. It's very easy to plan because everything is very visible. There is no, if you stay invested, there is no fluctuation. Then moving on to tax efficient options. So there are multiple. So we'll get into the details of it. There are multiple options that are available while investing in fixed income that give you tax benefits. So you can sort of invest in those paper to take benefit or additional returns, so to say, from these papers. Then finally, preservation of capital, right? Um, again going back to the first point, provide stability, right? What basically it means is, even when you have your goals in place, uh, you sort of know what is the goal for that particular plan, and you wouldn't want to lose that money, come what may. Fixed income is an avenue wherein there is a very high potential that your capital obviously gets preserved, obviously in comparison to other asset classes. There are other options available which give you much more security or comfort than fixed income securities. But again, there's a risk reward ratio that you have to sort of take care of. We feel the fixed income security provides you a very balanced risk reward ratio when it comes to investing. I'm not saying it's completely risk free or there is no risk available, but the ability to preserve capital in comparison to other asset classes is much higher. Then moving on to diversification. Now, this is again one of the very, very major, advantage that you get as a investor, as a prudent long-term investor, right? You should always and always work on diversifying your investments. You cannot put all your eggs in one basket, as the old saying goes. You always have to invest in different sort of asset class which moves, maybe not completely inversely proportional, but some sort of in proportionality has to be there, right? So fixed income is that asset class. It is generally works uh, in favor when equity sort of markets are on a going through a very volatile time. Fixed income has generally in past, you've seen, has been very stable and sort of outperforming equities when times are not great. So having two or more asset classes which work differently becomes more important, and fixed income sort of comes into a play because it gives you that avenue to sort of be present, and invest in asset class which moves differently. Then finally, potential of better returns over traditional instruments. So with the same sort of stability, preservation of capital and all those things, and periodic income taking in mind, there is always a potential in fixed income securities to earn more than the regular traditional investment that are available in the market. So these are the benefits. You need to understand those, match it with your goals, and then sort of asset allocate as per your risk profile and financial goals, and then sort of choose and go and say, okay, this much of my if I want to achieve X amount of money at in 5 years, out of which a particular sum I want to be very stable. I can't lose the capital. Want less volatility. That percentage should be allocated to fixed income, because it will give you potential to earn higher returns and provide you sort of stability in your investment journey overall. After understanding what the benefits are, let's move on to the options that are available under fixed income securities that you can sort of invest in today's Indian market. Uh, so basically types of bonds or types of fixed income securities. Starting from the the one of the most basically the highest AUM that we have in our Indian market. Just to give you a few numbers, more than I think 40% of India's fixed income assets are in government bonds, central government GSEC bonds. Also, we are also part of now. JM emerging bond index, that again will sort of increase the demand in, already has happened, increase the demand in GSEC market. So government bonds are nothing but bonds issued by central government, uh, comes with sovereign guarantee, and as considered are the most safest sort of investment with no credit risk, because it is backed by government of India, right? These maturity, although again these bonds are anywhere from maturity from as low as 1 year to as high as 30 years and above, right? And again they pay you semi-annual interest, fixed interest, and on maturity they'll pay you your interest, principal back. Then moving on to the state development loans, again issued by state governments to meet their budgetary needs or any funds requirement for development activities that keep coming in their budgets. And all state governments across India keep raising these, bringing these bonds in the market and raising money for their own, budgetary requirements and developmental activities. Again, they again, range from residual maturity of 1 year to 10 years, and again pays you a fixed interest. There's no fluctuating, and at maturity they'll give you a principal back. Similar on the lines of government bonds, state development loans, there are also municipal bonds for sort of bonds to raise money for their local developmental projects, schools, highways, hospitals, whatever they have in their mind. Can be both in in terms of short term to long term maturities. There are multiple ways. Even municipal corporations have can manage their fund requirement, and one of the ways is to sort of raise bonds. Again, because backed by sort of local and state government. Again, moving on to non-convertible debentures or corporate bonds. Generally, corporate bonds are NCDs in the market. These are bonds issued by companies in general. All any sort of corporate that wants to raise money can raise money via equity. We've already covered this. Anyone who wants to raise capital, there are two ways to raise capital. One is sort of take loan or give away equity. And one of the options via wherein you can raise money is via loans, sort of to say is NCDs. And again, corporate bonds have varying maturities, interest rate depending on the issuer, credit worthiness. They'll come off with different sort of coupons, different sort of maturities depending on what sort of project they want to raise this money for, etc., etc. There are and now that the currently in India, the percentage approximately of NCDs or money that is being raised by corporates via fixed income is around 20 to 25% roughly. I'm not sure of the exact number, but it's around this range. Now, what is happening is we are at a cusp of, like, India is at a cusp of like a growth trajectory already. Right, we have a lot of things working for us. Uh, Having a strong fixed income market and internally having a strong push from government to push these corporate bonds will really help India sort of go on a faster pedal, right? And those signs are already there, right? Corporate bonds initially could be only bought in multiple of 10 lakhs, most of the corporate bonds. Now that government or SEBI has come up with new regulation wherein all corporate bonds need to have a face value of 10,000 rupees. So investor can invest as low as 10,000 rupees also in corporate bonds. So these are small things that they are already doing, and these will keep happening. We can already see a lot of corporates. As I already said, 40 to 50% of market is market is covered by government or government entities, and hardly 20-25%. But if you see the number of issues, obviously the quantum is much higher in sort of GSEC and government issues. But number of issues that are coming from corporates are much higher, comparatively much higher than that you before, and that number is slowly increasing. So again, to quote a basic sort of idea, number of corporate bonds raised by entities which are double A and below are much higher than number of corporate bonds raised by triple A sort of entities. Um, then moving on to floating rate bonds. As the name suggests, it's nothing but the interest rate that is basically promised will sort of fluctuate as per any particular reference rate that would have been at that particular time, and it'll sort of fluctuate as per the that particular reference rate fluctuates. Generally, it is RBI's repo rate, but it could be anything, right? It's again upon the issuer and the contract between issuer and lender. Uh, floating rate bonds. Then moving on to commercial paper. Again, commercial paper is nothing but a short-term instrument that company sort of uses to take care of mostly their working capital requirements or any temporary liabilities. Commercial paper, as a rule, cannot be more than 364 days. So commercial paper are that can be minimum of 7 to 364 days, and that said, there is no sort of coupon attached to it. It's basically you are there issued at a discount, and on maturity you get your principal sort of back or face value back. Then tax-free bonds. Tax-free bonds currently available in India are only issued by public sector units. For a while, Government of India has not, or PSUs have not come up with a tax-free bond. What these basically mean is the interest that you earn out of these securities after investing in the securities are completely tax-free, 100% tax exempted. Uh, then moving on to zero coupon bonds, similar to commercial paper, zero coupon bonds again won't have any coupon attached to it. But unlike commercial paper, they can be of more than 1 year also. Again, what it means is there is no coupon payout, but you sort of get the bond at discount, and maturity you get it at your face value back. For example, if a face value of bond is 100, you pay, if it's a longer maturity paper, you pay 80 today, and at maturity you get 100 back. That is zero coupon bonds. Then moving on to perpetual bonds. Perpetual bonds, again, as the name suggests, sorry, they don't have any fixed maturity date, right? But they'll have a call date. So basically, these perpetual bond can go on till perpetuity, having no sort of end date. So once you invest in that particular paper, meaning you are invested till the time the issuer thinks it's time to give the funds back and take the call the bond back, right? So generally the call date is at a 5 year interval, 5 or 10 year interval, but it is completely on the issuer if they want to call the bond back or no. So investor has no choice here. Uh, so it gives issuer a flexibility to manage their debt, but obviously investor has a reinvestment risk that is attached. So basically, what it means is, at maturity, if you are not prepared to take the money back, you will have to, because at call date the issuer has asked for the bonds back, right? Uh, so those are perpetual bonds. Again, as a rule, perpetual bonds again can only be issued in to obviously protect retail investors. Government of India has come up, sorry, SEBI has come up with a regulation wherein perpetual bonds can be issued on only multiple of 1 crore face value. So if you want to invest in perpetual bonds, minimum amount required is 1 crore. Then convertible bonds. Unlike non-convertible bonds, convertible bonds are something that can be converted into shares of the issuing company. It's as simple as that, and basically offers investor potential for capital appreciation and also benefit of fixed income. Then moving on to the market-linked debentures. Um, Market-linked debentures are nothing but basically instrument that offers returns based on performance of underlying market index or instrument. Basically, what happens here is there is no sort of coupon payout through the uh, tenure of the fund. But on maturity, the coupon payout or the interest paid out depends on what sort of, where is your reference index at that particular point. And there are a few buckets that they create. And wherever your sort of reference index falls at that maturity point, there is already a fixed coupon in that particular bucket is what you will get paid at maturity with your principal. Uh, Market linked debentures were very popular in India a few years, at least a year, more than almost a year now. Were very popular a few years back because investors could sort of take advantage of the volatility in the market and sort of get tax advantage on it, which sort of later regulators sort of understood, and they changed the taxation of this instrument completely. And now whatever tax advantage sort of it had previously, whatever tax efficiency it would provide initially has completely gone. And then finally, obviously, the sovereign gold bonds issued by Reserve Bank on behalf of Government of India. Again, its security denominated in grams of gold tracks the prices of gold, gives you return as per prices of gold. But again, the advantage here is you get an interest rate of 2.5% over and above whatever the market fluctuation or market price of gold is per year in the hands of investors. So these are the basic types, and there are again subtypes or subcategories under all these heads that I've sort of said, and there are multiple permutation combinations that sort of work around this. But these are the basic types of bonds that are immediately available in Indian context, that are available for retail or even institutional investors to invest. Um, then after knowing sort of what sort of investment options that you have under fixed income, it also gets important to understand the price points or the price components of uh, fixed income securities while investing in fixed income securities. uh, so just to give or go back or give you an example of equity, if investor is investing in equity, right, there is a particular price attached to a equity instrument, right, or ABC company, and your returns are very visible. Right? If your ABC company is at 100 today, goes to 200 is your 100% return. You withdraw that 100 rupees, go back home, transfer your ownership to someone else. As simple as that, right? Or whatever, vice versa, 100 goes 50, whatever. It's very easy. Um, but when it comes to fixed income, there are multiple components that get added to the price that you have to be cognizant while investing in fixed income securities. So it's not only the base price of the asset. Unlike equity, where there is a base price and that is the end of it, in fixed income securities, that's not the case. There is a base price and there is an interest component that gets added, and overall, then it becomes your sort of total consideration, or a or a dirty price, so to say, in fixed income market. They, instead of saying total consideration, they call it dirty price. I'll get into the details of it, right? So I've given you two examples to better understand this particular price component. One is a primary trade. Primary trade, what I mean is, an issuer is coming up with a issue on primary, and it has not been traded before. The first time they are raising money at, it's a 5-year paper. They are offering 12% interest rate. The face value of bond is 1 lakh rupees. And that is about it. So on the day of primary trade, when it gets issued, what sort of total consideration a investor will have? Suppose you want to invest a quantum of 1 crore, meaning you will have to buy 100 bonds at a price of 1 lakh rupees, face value of 1 lakh rupees. So your price at that day will be, I think I made a mistake here. It's not 10 lakh. This price component should be 1 crore. So price is 1 crore, right? There is no accrued interest because it's the day one of the, there is no interest liability of at the end of issuer, because it's the day one sort of, day one of your investment, right? So your liability is only be stamp duty, and you pay your face value or whatever your price, which will be 1 crore rupees, and plus 10 rupees of your 0.001 is the stamp duty cost, right? So this will be your final total consideration, 1 crore. For better understanding, let's just keep it 10 lakh, 10 lakh, 10 rupees. Now when you move to a secondary trade meaning, consider that you bought this at a primary, this particular paper you bought it primary, paid your liability of 10 lakh rupees, and you're holding this paper. But in 6 months time, you realize that you want to sort of sell this paper because there is some liquidity requirement at your end. You want money for whatever reason, uh, whatever it could be, and you decided to sell. Now, just for the simplicity's sake, right? What I've considered here is a uh, trade date of 30th June, because that is exact mid-year, right? It'll be very easy for us to sort of calculate. So, for example, I said 6 months later, you want to sort of sell your this thing back. Now, what happens is when you are selling, so generally, uh, whenever an issuer has issued any particular fixed income security, uh, and it is listed in the market. Now, what happens is it will change hands constantly. It can change hands multiple times in a year, or even multiple times in a day. It gets very difficult for issuer to keep track of who is held the bond at what particular time, because you have to pay interest, and interest is he's issuer is liable to pay interest for the time being you're holding the bond. Suppose if I held the bond for 1 month, I'm liable to get the interest for that one particular month. So at issuer's end, it gets very difficult to sort of take or manage this changing of hands, and then sort of calculate and then pay interest as per who is held at what time. So what happens? What market practice is? Issuer doesn't sort of keep track of who has changed hands through the year, right? They won't keep a track. What they do is they will see who is holding the bond. Suppose in our example, first Jan is the interest payout date. So what they'll do is, I typically on 15th of December, they'll check who has on who's holding this bond is there, and on 1st Jan they'll pay that entire year's interest to that particular person who held that bond on 15th of December, or whatever. It could be T minus 15, 10, 7, according to whatever it's written in IM. So the entire money gets transferred to that particular holder. So now it is on seller's interest, or even a buyer's interest, to make sure that you take that money upfront, or pay the money upfront from a seller's perspective to the person whoever is buying. So in this example, if you see, uh, the trade date is 30th June 2024, right? Now the entire year's interest is 1,20,000, right? If a person investor sells this bond today to person ABC, that person will get the entire year's interest of 1,20,000 in Jan 2025. Now, as a seller, I have held this bond for 6 months, so ideally I should be getting paid for that particular holding period. So that my holding period is going to be 6 months here, exactly half year, meaning 60,000. So what I'll do is, and consider the price of the bond is not changed. There is nothing that has happened in the market which will sort of fluctuate the price of the bond. So what I'll do is, my price of bond, which is 10 lakh rupees plus 60,000 of accrued interest, I'll add into my price today, and that will be my selling price for the market. So buyer will sort of have to pay a price, inherent price of the security, that is 10 lakh rupees, plus accrued interest of 60,000 rupees, because you will have to pay the seller upfront, because you are entitled to get the entire year's interest at the end of the at interest rate. So basically, the price will be 1,60,000 total consideration. So this total consideration is nothing, in a market slang, what we call it as a dirty price, and the basic price or inherent price of the security is called as clean price. So clean price is nothing but the inherent value of the security. Dirty price is nothing but clean price plus accrued interest. What as a total consideration is considered as your dirty price. So yeah, I think this is it from my end. I would like to open the floor for question. I also wanted to get into the nitty gritties of yields and all, but I feel getting into the yield calculation or return calculation on online segment might get too difficult again, because there is no sort of interaction that keeps happening. But I'll still try in my upcoming sort of sessions, if I can in some way sort of try and simplify this even more and get into calculation of yields and understand the yields in a much better way. So yeah, thank you guys. Thank you from my end. I am okay to sort of take any questions if there are.
Yeah, do we have any questions? So this is time to wrap up our session now. Um, so as we conclude, let's apply this newfound understanding to make informed financial decisions. To all attendees, thank you for joining us. Let's continue this journey together. Stay informed, stay inspired, and stay empowered. Keep an eye out for our next informative webinar. Until then, stay connected with us for more updates. Thank you once again for being a part of YES FinPulse. Thank you so much, Sachin.